What is going on, investors? Hopefully you guys had a great day out there. Time to talk about the Walt Disney Company, better known as Disney, ticker symbol DIS. This company just reported their earnings after the bell, and the stock is performing rather nicely, up about 1.75% in the after hours. When we jump over the stock chart, this stock has gone like parabolic. I don't know if I've ever seen Disney stock go parabolic, but it certainly has over the last few weeks and months. And what's interesting is the parks are still closed in parts of Disney World and Disneyland. And so we got a $344 billion market cap on this one. So they talked about some things on the conference call. I think it was actually important to kind of wait for this video to have the conference call because they talked about how they bundled up some subscribers to the Disney Plus platform, and it kind of drove down their revenue and things like that in terms of revenue per user. Now, Disney rises on surprise profit with better than expected revenue drop and subscriber beat. We'll talk about those subscribers. The total direct-to-consumer subs, which includes Hulu, ESPN Plus, and Disney Plus, came in at 146 million. Wow, that's a lot of people. And they were expecting about 143 million. That Disney Plus is jumping to about 95 million subscribers around the world. They were expecting about 90 million. ESPN Plus is up to 12.1 million, and Hulu is up 39 million. That's a 30% rise in Hulu subscriptions. Now, let's jump over to the numbers. We'll talk about what's going on here. So we've got two different segments here with Disney. So you've got the Disney Media and Entertainment. This is like the TV channels like ESPN and ABC and things like that. And obviously the Disney Channel. And then you've got Disney Parks, Experience, and the products. And you see here the parks obviously still being closed, at least out here in California. I don't know when these things are going to open, but down 53%. You went from $7.5 billion in revenue this time last year all the way down to $3.5 billion. Obviously, I think the one in Florida is open. Maybe some other parts of the country, in other parts of the world, you might have a Disney World that's open, but it is still struggling to keep that revenue afloat. Now, the Disney and Entertainment division is struggling as well. You got movie theaters closed, things of that nature. You're down about 5%. So what you want to do is take a look at the operating income, which came down in the media segment, down 2%. So you had 5% decline in revenues, but you had about a 2% decline in operating income. Now, they've done a nice job with the Disney parks, because I tell you what, last year they made $2.5 billion on $7.5 billion in revenue. That's phenomenal margins for like an in-person thing. And here they are, they lost $119 million. I just kind of want to say that's it. That's pretty phenomenal considering they've cut their revenue in half. And while, yes, of course, revenue has dipped all the way down to a negative number, it's still not that bad. And then we take a look here, direct to consumer. This is all the Disney Plus, the Hulus, and things like that. You see here our revenues are up 73% over the last year. That is phenomenal. You've got the linear networks, which are basically flat. You've got content sales, licensing, and other. I would guess this is probably like movie theaters and things like that. You see that's down 56%. That hasn't recovered as well. And then now you get down to operating income. So one thing that you want to think about is, okay, well, they've got this direct to consumer is just the story of the day here with Disney. It's up 73%. Well, take a look. Well, our operating income's up 58%. But we lost $1 billion last year. This year, $466 million. They haven't quite hit the tipping point. My guess is either next quarter or the following quarter, they'll be at a break even or possibly a positive income. So that is why I believe this stock has just been on a monster run. Because first of all, I think investors are giving them credit for movie theaters eventually coming back. So you'll have some of this content licensing and sales come back. And then obviously you'll get the parks coming back as well. They talked about on the call that they have a fair amount. It seems like there's a fair amount of pent up demand to go to Disneyland. Obviously, if you have kids or if you're just a fan of going to Disneyland, you're probably looking forward to that. And so there's some pent-up demand. They should be able to get that back on track. When that is, how much capacity they can possibly have at these parks depends state to state, government to government. We'll see what happens there. But I believe personally that a lot of this good news has been pulled forward into the stock. I mean, just over the last like 3 or 4 months, the stock's gone from 120 up to 190, about $195 per share. That's pretty incredible. Now, some just really tight information here. So we've got some information on these are paid subscribers right here. So you see here with Disney Plus, look at this. You went from this time last year, you had 26.5 million subscribers to Disney Plus. Now you got about 95 million. That's just incredible growth over just a year's time. You got ESPN Plus, even something like that's growing quite a bit. And then you've got Hulu, where they kind of break it out with 2 different kind of versions of Hulu. But all in all, total Hulu's up about 30%. Now you've got your average monthly revenue per paid subscribers. I've talked about this, how Disney Plus went from $5.56 down 28% to $4.03. So they talked about this, that there's this Hotstar, and they kind of like bubbled. They got like 30% of Disney Plus's subs came from a Hotstar bundle, which is kind of like, it's going to lower the price. It's almost free in Asia. So it's something that is driving the cost of the average subscriber down, but it's something that in the long run could generate a little bit more money for Disney. You see ESPN's basically flat, and Hulu's up a little bit on this live TV bundle that they have going on. So all in all, everything looking pretty good. I think the things to emphasize is parks will likely come back. It's a strong profit. I mean, just massive profit in that division. I mean, once that comes back, profit will come back in Disney. And once movie theaters come back, and then you couple that with the fact that direct-to-consumer will likely be profitable when those things start to come back online. And that is why this stock is absolutely rip-roaring to the upside. The last thing I want to take a look at is from an asset perspective. This is a company with about $14 billion in receivables, another $17 in cash. Solid balance sheet, obviously. Now, on the liability side, not a whole lot going on here, honestly. Not a lot to see here. You'd think that this company might have really kind of had to lever up their balance sheet, but they controlled cost incredibly well over the last year. Everything looks really clean from a liability side. This is a company that obviously has had tremendous performance in the stock chart. And I think as you go through these numbers, while on the surface with the parks closed and things of that nature, on the surface, it looks bad, but when you dig into these numbers, there's actually a lot to like here, and I think that's what investors are doing. Now, stock's basically completely run away from you. I'm in this stock for probably maybe $110, $120 per share, so all the way down here. It's hard for me to comprehend wanting to step in here when the shares are at $195, although I was talking with a newer investor the other day, and they were talking about getting into Disney, and I was like, man, this stock is just completely run up. There is a small area right here at we'll call this $170, like almost on the nose. $170 if you get a pullback in Disney would be the first logical spot where I could see maybe wanting to step in on this one. You've got a big, large price gap down below it. So you want to tiptoe carefully. If the stock reverses, comes down to 170, it could fill this gap. That could get us down to 157. I'm kind of wishful thinking at this point, because I think there's a fair amount of people that would want to get in on Disney at that share price. But if you do have a market reversal, or just in general Disney reversal, there is some price targets down in this range between 135 and I will call it 155, which could be a viable buying opportunity if you get that kind of pullback. I think more realistically, 170, but still that's 20 something dollars off where the stock is today. Hopefully you've been holding this one like me and many other people out there, and you've just been able to experience the up and the rise in Disney. We'll see what happens next quarter. Over the last year, the stock is up about 33%. So I think a lot of the good news has been pulled forward. And it could be that the stock consolidates a little bit and you get a buying opportunity here. I would just stay patient with this name. Wouldn't necessarily come in here and try to catch this moving train as it moves upward. I'd wait for a little bit of consolidation. That's just my opinion. Hopefully you guys had a great day out there. That was the Walt Disney Company. We'll be back again soon. Good luck with your investments.